stock market trying to hold on. I got Alex Coffey with me, the other half of Next Gen Investing in studio. Microsoft and Activision, let's talk about this real quick. Microsoft's got a Zoom competitor with Skype, but this is all about video games, of course.
Yeah, if you recall yesterday we talked Broadcom and VMware in the UK approving it. We said, remember, that was the hurdle that Microsoft had faced, and they're addressing that. The UK Competition and Markets Authority had raised some concerns about sort of streaming and cloud related aspects of this deal. Well, Microsoft has restructured this to basically offload and transfer those cloud streaming rights for all current and new Activision Blizzard PC and console games released over the next 15 years to Ubisoft. And this, to me, is obviously a step forward. They're addressing the concerns. And you look no further than what we have on the screen, which is the Activision price, as it starts to harden and firm up towards that deal price. This is our basically barometer of, is this going to happen or not? This is about as close as we've ever been in terms of these prices getting to basically parity. And to me, that says we're about as close to this deal being done as we've ever been. Microsoft itself, if this was a different company, you may see some price reaction to the downside, to the upside, fluctuating as to whether or not this was good for the deal or not. Quite frankly, Microsoft is too big. This isn't, as crazy as that sounds, 70 billion or whatever this isn't enough really to move the envelope for a company the size of Microsoft. Okay, and it's odd to me that it never really has. I don't know. Just it's never, to me, ever shown up in Microsoft shares, which is, I mean, look, I get it. It's a big company, $61 billion, really putting an ironclad hold over some of the major game franchises. But there's still so many games out there, too. I've just always there's been a few things that have kept me awake about this deal. Number one is that Microsoft shares have never seemed to really care so much, which is fine. But the other one was that, antitrust in gaming seemed a little bit, strange to me, because there's all kinds of games of all forms you could play, from free to the most expensive. So I guess the thought was they make the place that you play on them, and then they would also be making the game, and they could kind of be anti-competitive there. But I'm with you. It's not like they're the only player in town in either facet, and not like it's a much needed life-saving drug or something. That one big pharma company is going to get a hold on. It's games. All right. So I think we're pretty close to being done on that story. Let's talk a pretty big drop here after earnings in Macy's. That's where the action is. The stock's down about 6.5% right now, right back to where it was last earnings. Yeah, and as we look at this, first thing you'll notice is actually a beat on both top and bottom line, but the guidance aspect of this story, I think, was the disappointment. You look at kind of what they talk about. They talk about the macroeconomic situation basically pressuring consumers. The interesting thing here is it doesn't seem to be pressuring consumers equally. It seems to be pressing consumers in certain places. Walmart had the exact opposite thing to say, but we talked about this yesterday as well, which, a Walmart strength doesn't necessarily mean companies like Macy's or Target or go down the line are all doing well. They're all kind of different and nuanced. This really is not the rising tide lifts all boats, aspect of the market. There are winners, there are losers every single quarter in retail. As it stands right now, Macy's seems to be continuing to be in that loser camp, as department stores just haven't really been the place to go. And Macy's just can't seem to figure out what it wants to be. Whenever a company is closing store footprint to kind of shore up costs, it's probably not a growth story. It's more of a, how can we be valuable for what we have left? And I just don't see investors flocking to this, and they're certainly not this morning. Every time I go in these days, rarer and rarer to one of these stores, mostly though Macy's, I have to say, where Nordstrom, you can get it a little bit more clearly pinpointed to a consumer, right? You go through Nordstrom, all right, most of the stuff is pretty nice. It's a little higher price point. You go get a suit made. You go and get a fitting for a dress or whatever. Macy's is like, what is this place doing? Every time I go in there is so much square footage. And it's just like, in today's world of retail, where there's so many brands shipping directly to people to get what they want, and people are willing to spend what they want. If you're not TJ, then I don't know where Macy's sits. TJ, I get. All the square footage in the world makes sense for TJ because people are going in there and pulling stuff off the rack. I can't for the life of me figure out why Macy's wouldn't have to keep closing down brick and mortar
sizes.
It doesn't seem that they have an identity either. TJX,
none whatsoever.
and some
no
Kohl's even, you kind of know you're going there for value. You go to Nordstrom, and not the rack, just regular, you kind of know that you're maybe on the upper echelon of spending.
Yeah.
Macy's seems to be caught between.
Good for you.
Yeah, it seems to be kind of caught in between. What I thought was interesting, though, is the CEO talks about, again, the macroeconomic uncertainty, but he said that they're leveraging robust data science tools to refine their inventory composition. This is something I would hope that they were
trying to talk AI to save Macy's stock.
They keep and reaffirm their guidance on both sales and earnings. So the sales range is 22.8 to 23.2. It's pretty narrow for a company that's in retail.
What does the AI say about thousands of square feet devoted to Armani exchange racks of like the same coat with weird patterns on it? It's just like
I haven't been there enough to comment on that. But earnings per share 270 to 320, a little bit more volatile range there. But I think this also highlights a greater issue, which is we watched during the pandemic this just-in-time inventory system break down for many of these companies when supply chains got disrupted. They, in many cases, when there was tons of stimulus and a lot of money flying around, moved to just-in-case. They were carrying bigger inventory because, hey, times are good. We want to make sure we have stuff to sell. The worst-case scenario for us right now is we just don't have any goods. People want to buy them. They go somewhere else. Well, now that it's sort of shifted to, the money that's being spent is being spent elsewhere, it's like, well, we can't have any inventory on hand because then we're going to have to, mark down and take losses there. So interesting dynamic playing out in retail, and really not just in apparel, not just in retail. You see it in semiconductors and other spaces too, as inventory and supply gluts have worked their way through the system.
Okay. All right. Well said. Stock getting hit right now, but retail is just having a tough go of it. Target's also down this morning, about 2.5%. Daiwa cut the stock there after being a bull, saying back to neutral. So not a great day for retail, down 2%, including, of course, the Dick's drop as well, down 24%. Thanks, Alex. All right. Good stuff.